Tomorrow is 2026, and it'll be a whole new year for small business deal making. What do you think is going to happen? Well, I'm going to tell you what I think is going to happen for next year with my list of 2026 small business predictions for deal makers.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
Hey, welcome everyone. We got a whole new year coming, and of course, people are interested to know what the new year is going to bring. I've been spending some time thinking about it, and I've got a list of predictions that I want to share. And I also want to know what you have to think about them. So if you hear something that I say that you disagree with, or you think is correct, or whatever, put comments down below. Let me know how you feel. But in general, I think that it's safe to say that there's a little bit of apprehension about 2026 for the economy in general. I've been watching a lot of stuff that's saying that certain number of American states, for example, are already in a recession. I know that I talk with business owners all the time in Canada and the United States, and on both sides of the border, like a lot of businesses are kind of taking these wait and see approaches because they just don't know what's really going to happen, especially anyone involved in the import or export of things or who use imported stuff in their own processes. These wild changes in things like tariff rates and stuff have made everyone really uneasy about what they should or shouldn't do. And as soon as a business decides not to make an investment, for example, not to buy equipment or expand to a second location or whatnot, the money they would have spent doing those things, well, that money would have been another business's income, right? And so any kind of reason people have to not spend money means that money is not flowing through the economy, and this is part of the reason why we're seeing the results that we're seeing. Um, and then there's not just, businesses not spending as much. We've also got increased interest rates, which are having an effect on the general public and households, I guess, in particular. So I know people, for example, that are involved in the furniture business who say that there's been like a 20% drop in the sale of furniture over the past year because furniture is so often tied to the acquisition of a new home. You move houses, you need to buy some new furnishings, decor items, get the place painted, like all that kind of stuff is affected by high interest rates, which discourages people from moving from one house to another. We're also seeing record auto loan defaults in the United States. We're seeing record breaking credit card debt balances in Canada. Essentially, consumers are reaching the point where they are tapped out, largely, I think, because people are getting beaten with the inflation that is showing up in everyday consumer prices at the grocery store, et cetera. Some people are relying on debt in order to be able to make ends meet. Other people are not making their car payments, obviously, right? So this is overall not exciting good news. But how, in particular, is this going to affect the world of small business deal making, which is what we are, interested in here on this channel? So, topic number one, I'm going to call it SBA and bank financing, right? So, what might change with the Small Business Administration in 2026? So, we already saw that when the Trump administration came in, that they tightened up some of the rules that had been loosened up under the previous administration. And, you know, that kind of adjustment, I think, is quite normal for any kind of organization. They're going to say, "Hey, what has been going on here? What do we think a problem might be? Let's make some adjustments." Now, if the SBA were a perfectly rational insurance program, because the 7A loan program is supposed to be an insurance program, because what they do is they put guarantees to the banks for small business loans, and they charge a fee to the borrower. And that fee is like an insurance premium, which goes into a big pool of money that is used to help then solve or resolve the defaults, right? So if you're an insurance company and you predict that there's going to be more claims, what would you do? You would probably increase your premiums and make it more difficult for people to qualify. This is what we're seeing like down in Florida, right, with home insurance, because there's been more of these big storms come. And so the insurance rates are going up because the insurance companies have to adjust to make sure that they've got more money coming in from premiums than are going out for claims. And in a rational world, the SBA would be doing this as well, which would make me inclined to think that they could be considering tightening up their rules and maybe reducing the amount of overall leverage that they will do on an acquisition loan. Back when I first got into business brokerage, it was around the time of the great financial crisis, which was quite some time ago, 17 years ago, in fact. The Small Business Administration did not do 90% financing of any kind, right? I think the maximum leverage they were doing at the time was 60 or 65%. And they wanted to see a big amount of buyer equity, like 25%, and they wanted to have at least 10% seller notes. So this 90% leverage is really something that has evolved since the last downturn. Now, I've mentioned in a logical, perfect world, this is what we would see happen. What has surprised me a little bit is that they're increasingly not behaving that way. So back in 2020, the SBA was tasked with rolling out the payroll protection program loans. They took on a bunch of, disaster relief type of stuff when it came to the economy in 2020. And so I increasingly believe that the SBA could be used as a tool for implementing political policy based on whatever the administration wants to achieve. So that means they may not respond in the way that I'm saying. So that's my prediction. So my prediction is default rates could go up and they may not change what they're doing because of government policies wanting them to continue to let money flow more freely. However, in other places around the world, I don't think that necessarily will hold true. In Canada, I'm already seeing that lenders here are becoming more conservative in general with the small business loans that they're willing to entertain. I even had a lunch meeting a couple weeks ago with a banker who does acquisition loans here in Canada, who was just saying like how his underwriting criteria is starting to become tighter and tighter. They're really getting much more concerned about collateral, and when it comes to cash flow loans, they're they're looking at them much more carefully than they have in the last little while. And this to me indicates that the economists that work over at the banks are probably giving warnings to these people like, hey, like we have to be careful. There's a bunch of clouds on the horizon. And a business's risk, its riskiest point when you do an acquisition deal is always the day after you do the deal, because that's the point at which your leverage will be the highest. If you did a deal 4 years ago, you've already been making payments on the loan for 4 years, right? Which should imply, if it's a profitable business, that the balance sheet has been strengthening every year since you borrowed the money. So a business that is getting a brand new loan today is going to have a riskier balance sheet than one that got a loan a few years ago. And this is why banks changing their lending criteria in the face of these economic news of any kind is one of the ways they respond, because they understand this perfectly. That a good solid cash flowing business, once you apply a high degree of leverage to it, is an entirely different kind of business. And it doesn't take much to upset things in the marketplace, such as new entrants or you know costs changing or whatever, for the money left at the end of the day to disappear. We talk often on this channel about how a 10% decline in sales could be a 50% decline in profit for a lot of businesses. And of course, banks are aware of this. And with coming recessionary news and inflation, uh, the margins can get pinched, right? So those are my predictions. It's going to be harder to get a loan unless the government politicizes the SBA, which means it may not be harder to get a loan in the US, but it may still not be wise to get one, is what I'm saying. Okay. To the degree that some people have been doing it, I'll caveat that. Number two prediction, seller financing trends in 2026. So I expect the difficulty and reluctance from banks, right, to be a key driver for buyers asking for higher amounts of seller financing from sellers. Back when I was first a business broker, it was during the great financial crisis 17 years ago. And a lot of the deals that I ended up doing during that time were done with no banks at all. So it was just buyers making down payments and sellers financing the balance because the banks would not participate, right? And so I don't know if it'll go to that degree, but I certainly know that there's going to be increasing pressure from buyers saying, I want sellers to wear more risk in this deal. I want more accountability for what I've been told. I want more accountability to the history. And if there's any kind of like customer concentration risk or whatever, sellers expect to be asked to finance more of the deal and to have some kind of contingencies on those important customers being tied to how much you ultimately will receive under the seller financing, or more kinds of earnout provisions where you actually get paid based on the performance of the business. Now, we talk about this stuff all the time on this channel. What I'm saying is for next year, it's going to become an even bigger topic. And right now, or up until now, there have been plenty of sellers in hot industries which just haven't had to deal with this because there's been so many buyers that have been pursuing them. And when the market turns down, when the economy is in trouble, there's going to be fewer buyers willing to do the deals that sellers are going to be happy with. Sellers are going to have to negotiate a little bit more and give in to some of the demands of these buyers. So, prediction then with respect to seller financing trends is that uncertainty about performance in the future will reignite the 2020 and 2021 deal making trends of increased earnouts and deferred payments of all kinds. We saw that right after the lockdowns, where people were saying, "Hey, I think the business will rebound. I'm not sure if it will, etc." We're going to see that again. Like some of the furniture stores I mentioned that have been, had their earnings decline by 20% this year, or their sales decline by 20%, what would that seller say to somebody? It's going to be better next year? I don't know. That's an exact case for an earnout. Number three, multiples and valuations. So on Main Street businesses like 500,000 in cash flow to the owner and less, same as usual. It's like the multipliers are low throughout the cheap money period of 2021, 2022, like when the prices of everything else went up. The biz buy sell reports were consistently saying that on Main Street the multiples didn't really change. Okay. And this is primarily because we were talking about owner operator businesses. Buyers know that any future gain is going to be based on their own work. There's a limit to how much they're willing to pay sellers. So I don't really see multiples on Main Street changing. And if the business's performance has gone down, that means the price will go down if the multiplier remains constant. So I want to be clear. I'm not saying the prices will remain the same. I'm talking about the multipliers. Okay. In the lower middle market, so would be businesses with a cash flow to the owner of like 500,000 to a million kind of ish in that space. Multiples went up in 2021 with the cheap money that was available, right? And there was a huge influx of newbie buyers, people backed by private equity who couldn't find any return or yield in the public securities markets, started coming into this market, and a bunch of MBA grads came into this market with the whole search funder thing, and they drove up prices. And with the cheap money, they could afford to pay those high prices. Over the last year or two, the money's become more expensive with these interest rate increases. Sellers still want those 2021 prices. And so what we've seen over the last year and a half, 2 years, is people trying to meet the price expectations of the sellers with creative deal making. So they'll put in earnouts or contingent seller notes and all this kind of stuff, but they want the top line price to still meet those 2021 expectations of the sellers. My prediction for 2026 is that the multiples will deflate, that nobody's going to try to pretend anymore. Like the prices have to come down because the businesses just can't support the prices you know, that they could in 2021 with the super cheap money. So, additionally, I think this will be exacerbated if there is any kind of significant or material decline in the stock market. Why? Because a lot of the interest in the lower middle market has been driven by private equity type of investors who, quite frankly, can't find any yield anywhere. They're like, how do we make money on our money? Like we can't find any good stocks to put our money into. We can't find any good bonds or debt instruments or whatever because everything got bid up so high in the stock market, right? And so then they said, well, maybe we can find something in the private markets. Maybe we can find some small businesses or whatever. And so this phenomena over the last few years of seeing private equity groups go lower and lower and lower into the size of businesses they're willing to buy has been entirely driven by this capital pushing its way in, trying to find yield. If the stock market falls any amount of money, they're going to be able to find deals over there. So the push from the capital seeking a place to get an earning is going to be declining. As well, a lot of private equity money is tied up in private companies right now that are having a hard time turning over. And increasingly, the people who have always been the investors are starting to realize, hey, maybe there's a liquidity issue here. Maybe I'm not going to be able to get my money back out. And what we're seeing is we're seeing these sort of continuation vehicles being created where the private equity groups are saying, okay, well, we'll take our private company, we'll sell it into some new entity, and then we'll publicly list it, right? Which means that they're trying to get liquidity for their PE investors by pushing something into the public market. Now, I don't discuss public securities here, but it would seem to me that we always know that private businesses and private markets are rather illiquid, and public markets and publicly traded stocks are much more liquid. In fact, we see a difference in the multipliers between publicly traded stocks and private stocks. So this move by private equity entities to create publicly traded vehicles to sell their private companies into obviously makes sense because they can probably get a higher valuation multiple on it. Um, the question I would have is, do you want to be buying something that no other rich people want to own, right? Anyway, so so my prediction is multiples and valuations, the multiples are going to start to fall in the lower mid market to mid market space in 2026. Prediction number 5 relates to first time buyers. Okay. So there are two distinct groups of first time buyers I want to talk about here today. So there are people with real business experience that run, manage, etc., businesses within maybe another company, right? Experienced manager, 20 years experience, decides to step out and buy a business. That's one kind of buyer. The second kind of buyer is the person with absolutely no business experience at all, which we've seen a ton of over the last few years. And I think that that is going to start tapering off. So I predict for 2026 that the guru refugees out there that are trying to make deals happen with the things they've been taught in their $10,000 courses, I think this is going to decline as people begin to see the real risks in small business with the overall economic downturn that is happening. People are going to see businesses fail on a more regular basis, and they're going to realize that small business ownership may not be the panacea that they believe it is, right? It's not going to appear anymore as the easy sort of lucrative path to quick wealth that maybe they've been sold on. And so and increasingly funding is going to become more difficult for these non-experienced people, right? Because the lenders are going to be even more careful about who they lend money to, and will this person be able to take care of our money in their deal. I predict that experienced business people who lose their jobs and decide to buy a business, I predict that group will increase because I saw that back during the great financial crisis where these executive level people that had run businesses, like run manufacturing plants and all this kind of thing, like they lost their jobs. And so they went looking for businesses similar to what they had operated to be a buyer. And they make great buyers, quite frankly, because they actually have some business experience. They know how it works. Um, this means also that sellers are going to, sorry, the second part of my prediction about experienced business people is because they are experienced, they're going to be harder to fool with the notion of sort of the guaranteed sales and revenue that come with buying an existing business. One of the consistent themes that's always told to people about buying versus starting a business is that if you buy a business, you already have the customers and sales. More experienced business people are more aware that there could be risks that the customers are actually tied to the seller, number one. And they're also aware, usually because of their business experience, what a sales and marketing methodology and process might look like to go and attract new customers. So, an experienced business operator is not going to be so wooed by the established revenue of an existing business, especially if there's no strategic moat protecting that revenue. And so, these experienced business buyers are going to be much more open to doing a startup. And so I think that sellers, especially sellers that are in a business with no strategic moat, in 2026, you're going to have to increasingly compete to sell your business with people who can also see that they can start something, especially if there's more failures in your industry, making equipment, material, and labor less expensive and more available. So the whole positioning of buy versus start is going to be increasingly important for anyone who wants to sell their business in 2026. Are there real advantages in buying your business over somebody starting something from scratch? 4.5. So I jammed this one in after I made my planning. I predict in 2026, the myth of the easy business to buy is going to break. So we've all seen this. We've seen like videos on YouTube where people are like, oh, it's easy to buy this business and make a lot of money. So, I don't think there's going to be many videos made about laundromats, car washes, HVAC, e-commerce, or home health, right? It's just not going to happen. The whole buying a business is easy online crowd is going to look increasingly foolish in 2026 as it becomes increasingly obvious that small business is a difficult thing to do, and that you can lose money and that it is hard to make a business go, and that it's subject to all kinds of risks, from employees showing up drunk to losing your biggest customer to having a customer increase prices dramatically. I was on the phone with a guy in California a couple weeks ago. Some of his costs have jumped like 15%. And it's not just material costs, it's because one of his suppliers was bought by a PE group, of course, who's trying to increase returns, right? Because they paid a really healthy price for the business. And now he has to pay a higher price. And unless he finds an alternative, right? So here's what I expect you to find is I expect you to see many old videos, blog posts, and podcasts mysteriously get deleted in 2026. I'm talking about from the past 5 or 6 years. Prediction number 5, the distressed opportunity wave is what I'm calling this one. So I'm going to suggest we're going to see an uptick in forced sales or liquidations of small businesses from retiring baby boomers who waited too long and were not flexible and didn't take the reasonable offers they might have been presented in the past year or two. I'm going to say there's going to be increasing number of businesses that will be forced to shut down and close because of COVID era loans that they're still stuck with. And I run into them all the time. People that still have loans on the books from 2020 era, and the business never quite recovered, and they may be servicing those debts, but they can't really pay them down. And if they have any kind of downturn in their business, those debts will actually be a contributing factor in pushing them over the edge. Uh, Weak balance sheets in general kind of relates to what I just said, but rising costs in labor, insurance, and compliance. So this is like new rules, regulation, etc. All of these things is going to put increasing pressure on marginal businesses, potentially forcing them to close. The sales of marginal or money losing businesses will either uh, with either generous terms or low prices and or just the liquidation of business assets will allow for cheap startups, right? This relates to the previous point I made about experienced business people. And the thing with a cheap startup is if you can start a new business with used equipment that you buy on that is inexpensive, you can potentially get into an industry where your competitors, the established businesses, have liabilities, cost structures that they're not able to rationalize very quickly, the startup can actually have a cost advantage and be able to come in and offer lower prices, right? And so this increasingly will deteriorate the prospects of the established business, in particular for businesses without a strategic moat protecting them, you know, and keeping the customers sticky. So this type of business due diligence, when you go to look at a business as a buyer, is going to increasingly be important. Like, why do the customers have to keep doing business with this business? If they don't, why are they choosing to? And will these conditions continue after I am the new owner? Very important questions. Prediction number 6, failure rate in due diligence. So there's no hard and fast numbers that you can find about this. It's all anecdotal. People like to say that about half of deals fall apart in due diligence. Um, my prediction is that failure in due diligence will increase. It's going to go up, and buyers will ask for longer periods of time so they can delay the final closing cost components until they're absolutely sure that they want to do the deal. So this is part of what I discuss in my Business Buyer Advantage program about how to properly structure the timeline of a due diligence. If you want to learn more about Business Buyer Advantage, go to businessbuyeradvantage.com. But in the due diligence sections, I explain why you want to do due diligence in a certain order and why, because it's a cost controlling plan. When there's a whole bunch of buyers that are after the same business, you sometimes are under pressure for a truncated due diligence or a shorter period of time. When there's a recession or a downturn and there are fewer buyers in the market, buyers are often able to then make better offers for them as far as the timeline of due diligence, right? And so my prediction is due diligence will be longer and more deals will fall apart in due diligence, particularly because of issues with lenders, which was the first thing I talked about. So buyers will make offers under the belief that they can get certain financing. They'll go to the lender. The lender will say, no, we won't do that, but we will do this. And then they'll come back with amended offers that sellers won't be wanting to do. And if you're a business owner right now, I would say you really want to understand what is realistic for you and what a good offer is potentially going to look like. I can tell you it's much better to get your asking price and finance 40% of the deal than it is to maybe wait another 2 years, have your profitability decline, have the value of your business go down, fight and struggle over the next 2 years, hoping that you can make it recover so that you might be able to come back in year 3 and get your original asking price again with only a 15% seller note, right? Because I mean, if you want to retire, you're talking about 3 more years at retirement age now being put back into the business. And so the biggest hurdle a lot of sellers face is they don't realistically understand what a good offer might look like. And so they say no to deals that are good deals that could allow them to actually exit. Um, Number 7, my prediction number 7, the balance sheet will matter again. What does that mean? It means that the buyers who do deals in 2026 are going to be even more concerned about the footing that they have and the risks that they're taking and what the balance sheet or the strength of their business is. So the book that I wrote this past year, The Business Fortress, if you haven't read it already, check it out. Wrote it with Mark Willis. We talk about business resiliency and balance sheet strength a great deal in that book. Buyers in 2026 are going to be well aware that they need to be properly capitalized and that their opening balance sheet looks strong. When you do a business acquisition in an asset purchase, which is one of the most common ways that these small business deals are done, then you're not typically getting all of the operating capital transferred over to the buyer, right? When you do the deal. Sometimes the seller keeps cash, sometimes they keep receivables as well and pay off their payables. But the buyer is going to want to fully understand what degree of operating capital is required. And even if they have to put their own money into their own company to capitalize it from an operating capital point of view, they're going to want to make sure that they're on a solid footing. So if more of the buyer's money goes into their own entity to make sure that they're in a safe situation, it means that less money is available to give to the seller, right? Less down payment money is available. And so this again is going to be creating pressure on some of the things I mentioned earlier, which is higher amounts of seller financing being requested or deal structures with more earnouts, delayed payments, contingent payments, seller notes in the future contingent upon X, Y, and Z occurring, whatever. So those are my predictions. Now, what do you think? I mean, do you think one of those is the most likely to be true? If you do, let me know in the comments down below. And if you think I'm full of it and I'm completely wrong, let me know in the comments down below. I'd love to hear what you're seeing. If you are a deal maker, a business broker, a banker, or whatever, and you agree or disagree with any of these predictions, please leave the comments down below. Uh, they really help other people think through what they're getting involved with here as we head into 2026. And so, with that, I'll say thank you very much, and I'll see you next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.